Yesterday, oil crossed $100 a barrel. Not slowly, not gradually. Brent crude surged 7% in a single trading session to close at $100.69, the highest level since before the United States and Iran reached a temporary ceasefire last month. And while that number might sound like an abstract piece of financial news, something that happens in markets far removed from your daily life, I want you to understand something in the next 30 seconds that most people will not figure out for weeks. That $100 oil price is not just a number. It is a trigger. It triggers inflation. It triggers Federal Reserve action. It triggers higher mortgage rates, higher credit card rates, higher car loan rates, and higher prices on almost everything you buy. And as of yesterday, the probability that the Federal Reserve raises interest rates at its September meeting has jumped from 52% to over 80% in a single week. Your financial life, the cost of your home, your car, your groceries, your debt is being reshaped right now by a war in the Middle East and an oil price that most Americans are not paying close enough attention to. Today, I am going to tell you exactly what is happening, why it matters for every dollar you have, and precisely what you need to do about it. Let me take you back to where this story begins, because understanding the sequence of events is the only way to understand why we are here right now. Earlier this year, the United States went to war with Iran. The conflict sent oil prices surging above $110 a barrel in March, triggering an inflation spike that drove the consumer price index to 4.2% in May, the highest level since April 2023. The Federal Reserve, under new chair Kevin Warsh, held rates steady, but made clear that nearly half of all policymakers supported a rate hike if inflation did not come down. Then something unexpected happened. A tentative ceasefire was reached between the United States and Iran. Oil prices tumbled. Brent crude fell from the $110 range all the way back toward the mid-70s. Inflation cooled. June CPI came in at 3.5% better than expected. The market breathed. People thought the worst might be over. And then on July 23rd this week, Yemen's Iran-backed Houthi rebels launched attacks on 2 Saudi oil tankers in the Red Sea. The attacks compromised a critical alternative shipping route that vessels had been using to bypass the blockaded Strait of Hormuz. Oil surged 7% in a single session. Brent hit 100.69, and every piece of economic progress from the past month evaporated in a single trading day. I want to explain something that most financial news coverage gets wrong, and it matters enormously for how you should be thinking about this. When people talk about oil prices and inflation, they usually focus on gas at the pump. And yes, gas prices are currently averaging $4.09 per gallon nationally, with diesel at $5.20 per gallon. Those numbers are painful. But the impact of $100 oil goes so far beyond what you pay at the pump that focusing only on gasoline is like looking at the tip of an iceberg and ignoring the 90% that is underwater. Energy costs ripple through the entire economy. Freight costs go up, which means everything you order online costs more to ship. Plastics become more expensive, which means packaging, containers, medical equipment, and consumer goods all carry higher production costs. Fertilizer prices rise because fertilizer is largely petroleum-derived, which means food costs go up at the agricultural level before a single grocery store has even marked anything higher. Airline costs surge, which is why airline fares are already up 26.5% year over year. And all of those increased costs eventually show up as inflation in the consumer price index, which then influences what the Federal Reserve does with interest rates, which then determines your mortgage rate, your car loan rate, your credit card rate, and the return on your savings account. Oil does not just affect what you pay at the pump. It affects almost every financial decision you will make in the next 12 months. Now let me talk about the Federal Reserve, because the Fed's next move is the most consequential financial event on the horizon for ordinary Americans. The Federal Reserve meets on July 29th, 4 days from now. Economists surveyed by FactSet widely expect the Fed to hold rates steady at 3.5 to 3.75% at this meeting. That would mark the 5th consecutive meeting in which the central bank has left its benchmark rate unchanged. But here's what changed this week. Before the Houthi attacks on the Saudi tankers, Fed funds futures traders were pricing in roughly a 52% chance of a rate hike at the September meeting. After oil crossed $100 on Thursday, that probability jumped to over 80%. 80%. in a single week. Nigel Green, the CEO of Devere Group, an international investment advisory firm, said directly in a July 23 email that the case for the Fed to hold rates steady has become much more difficult to justify than it looked even a few weeks ago. The 10-year Treasury yield, the benchmark that most directly determines your mortgage rate, rose above 4.69% on Thursday, its highest level since January 2026. The 30-year Treasury bond yield climbed to 5.167%. These numbers are not abstract. They are the actual rates that determine what you will pay if you try to buy a home, refinance an existing mortgage, or take out a car loan in the coming months. Let me put real numbers on what a potential Fed rate hike means for your household. Right now, the average 30-year fixed mortgage rate is hovering around 6.9%. If the Fed raises rates at September's meeting and markets reprice accordingly, mortgage rates could push towards 7.25 to 7.5% before the end of the year. On a $400,000 home, which is roughly the median home price in America, the difference between a 6.9% rate and a 7.5% rate is approximately $160 per month. Over 30 years, that is $57,600 in additional interest payments. On a car loan, rates are already averaging over 8% for a new vehicle. A quarter-point Fed hike could push that above 8.25%. On a $50,000 car loan over 60 months, that additional quarter-point costs approximately $300 over the life of the loan. On credit cards, where the average rate is already 22%, additional Fed hikes translate almost immediately into higher minimum payments for anyone carrying a balance. The Federal Reserve does not just set a number in a room somewhere. Its decisions touch the real financial lives of every single person in this country who has a mortgage, a car loan, a credit card, or a savings account. Now I want to introduce you to something called WTI crude, because this is the number you actually need to be watching, not Brent crude, even though Brent gets all the headlines. West Texas Intermediate Crude, or WTI, is the benchmark directly tied to domestic refining and consumer fuel costs in the United States. When financial analysts talk about Brent hitting $100, they are talking about the international benchmark. WTI, the number that actually drives your gas prices, was at $92.19 per barrel on Thursday. That is meaningful because there is a gap between Brent and WTI right now, and that gap is being maintained in part by China. Chinese oil imports plunged more than 41% in June, according to customs data. That extraordinary pullback in Chinese demand has helped contain the broader global oil price, even as tensions in the Middle East push Brent higher. Goldman Sachs now expects China could ramp up buying again as soon as this month. If that happens, if Chinese demand returns at the same time Middle Eastern supply is constrained by the Iran war, WTI could quickly follow Brent above $100. And if WTI crosses $100, the transmission to American gas prices, inflation, and Federal Reserve policy becomes direct and immediate in a way that the current Brent-WTI gap is partially buffering against. Watch WTI. It is the most important number in your financial life right now that nobody is talking about. There is an additional layer to this story that I think deserves serious attention: the geopolitical dimension that is making this situation genuinely different from previous oil price spikes. The Strait of Hormuz, the narrow waterway between Iran and the Arabian Peninsula, through which approximately 20% of the world's oil supply flows, has been effectively blockaded during the US-Iran war. Vessels have been using alternative routes to bypass the strait, including through the Red Sea via the Bab al-Mandeb Strait. The Houthi attacks on Saudi tankers on Thursday targeted precisely that alternative route. So right now, the primary route and the backup route are both under threat simultaneously. Jordan and Kuwait, both U.S. allies, also reported fresh attacks from Iran on U.S. strategic interests on the same day. President Trump has warned of a massive attack against Tehran if there are additional attacks. This is not a situation with a clear or near-term resolution. And every day that the Strait of Hormuz remains effectively closed is a day that global oil supply is constrained, which means every day is another day that inflation faces an upward structural pressure that the Federal Reserve cannot control through interest rate policy. The Fed can make borrowing more expensive. It cannot drill new oil wells or reopen shipping lanes. The supply shock. Driving this inflation is real, physical, and geopolitical, and that makes it far harder to resolve than the demand-driven inflation of 2021. I want to take a moment here and speak directly to the people watching this who are feeling the weight of this situation in very personal ways. Maybe you are trying to buy your first home, and you keep watching mortgage rates climb every time you think you are close to being ready. Maybe you have credit card debt, and you are already struggling with the 22% interest rate that is devouring your minimum payments. Maybe you work in an industry that depends on fuel costs, trucking, food delivery, construction, agriculture, and you are watching your operating costs go up in ways that your pricing cannot absorb fast enough. Maybe you are on a fixed income, and every time energy prices go up, you feel it immediately in your heating bill, your electric bill, your grocery bill, and your gas tank. I want you to know that the financial pressure you are feeling is not a result of poor decisions. It is a result of being an ordinary person trying to navigate an extraordinary economic environment, one where a war in the Middle East, a blockaded Strait, and a central bank trying to fight inflation with a blunt instrument are all colliding at once in ways that no individual could have anticipated or prevented. Let me now give you the most important question to ask about this situation, because I think most financial commentary frames this wrong. The question is not whether the Federal Reserve will raise rates. The question is whether $100 oil is temporary or persistent. And here is why that distinction matters so much. Bank of America economists have argued that the Fed should not respond to what they call transitory shocks, meaning oil price spikes driven by geopolitical events that could resolve relatively quickly. Their case is that if the Iran war ends or de-escalates, oil could fall to $50 to $60 a barrel relatively quickly, and if the Fed raises rates based on current oil prices and then oil falls, they will have made financial conditions tighter than necessary in a slowing economy, potentially causing more damage than the inflation it was trying to fight. On the other side, Fed Governor Christopher Waller has explicitly said the Fed must not repeat the mistakes of 2021 and 2022, where they waited too long to raise rates amid rising inflation. These two camps, the wait and see camp and the act, now camp, are fighting over the most consequential monetary policy decision of the year. And the outcome of that fight will directly determine the interest rate environment every American lives in for the next 12 to 18 months. So what should you actually do right now? Here is specific, honest, practical guidance based on the current situation. First, if you are planning to buy a home in the next 6 to 12 months, do not wait for rates to fall. The 80% probability of a September rate hike makes it highly likely that mortgage rates will be higher 6 months from now than they are today. If you can qualify and afford a home at today's rates, waiting for better rates could mean paying more. If you cannot qualify or cannot afford it today, focus on the factors you can control: your credit score, your down payment, and your debt-to-income ratio. Second, if you have variable rate debt, particularly credit card balances, home equity lines of credit, or adjustable rate mortgages, treat eliminating that debt as your top financial priority right now. Variable rate debt moves up when the Fed raises rates. Every dollar you eliminate today is protected from a rate hike that now has an 80% probability of arriving in September. Third, if you have money sitting in a regular savings account earning 1 or 2%, move it immediately to a high-yield savings account. The best high-yield savings accounts are currently paying between 4.5 and 5% annually. In an environment where rates may go higher, those returns are likely to increase further. Your emergency fund should be working for you right now. Fourth, review your energy exposure. If you drive a lot, this is the moment to honestly evaluate whether there are ways to reduce your gasoline consumption, not because gas prices are permanently going to stay this high, but because you cannot control when they will come back down, and you can control how much you spend on fuel in the meantime. Here is the honest summary of where we stand on July 25th, 2026. Oil is above $100 for the first time since the Iran war first escalated. The probability of a Federal Reserve rate hike at the September meeting has jumped from 52% to over 80% in a single week. The 10-year Treasury yield is at its highest level since January 2026. Mortgage rates are near 7% and may go higher. Gas is averaging $4.09 a gallon nationally. The Strait of Hormuz is effectively blockaded. The backup Red Sea route is under attack. China may restart oil buying this month. And $100 oil price ripples through freight, plastics, fertilizer, airlines, and food, which means inflation is not done yet. None of this means the economy is collapsing. GDP grew 2.1% in the first quarter. Jobless claims are at historically low levels. Consumer spending is still positive. But the comfortable rate-cutting environment that many Americans were expecting in 2026 has been replaced by the very real possibility of rate hikes, and that changes the math on every major financial decision a household can make. The people who come through this period in the best financial shape will not be the ones who ignored it or waited for better news. They will be the ones who paid attention, understood what was driving it, made adjustments to their debt and their savings, and positioned themselves to handle higher rates rather than being caught off guard by them. The $100 oil price is not just a headline. It is a signal, and now you know exactly what it means.